Let's turn to the market action this morning. U.S. stock futures falling amid the back and forth between the U.S. and China on trade. Our next guest says stocks leveraged to economic growth are the most at risk amid the ongoing geopolitical uncertainty. Joining us now, we've got Brad Neuman, who is the Alger's Director of Market Strategy. Great to have you here on set with us. What are those stocks from your perspective, those plays that are most exposed here?
Yeah, thanks for having me. I think investors need to move from reacting to tariffs to kind of having some kind of opinion as to how they'll play out. And I don't know exactly when they'll go into effect. Maybe they'll be wrapped up with the budget reconciliation in the spring, but I do think tariffs are going to be an unsettling force for the market. And so I think companies, materials companies, industrial companies, heavy machinery, some consumer discretionary companies, those companies that really need the economic wind at their back are susceptible. So value type stocks, I think.
How much of this risk has been priced in?
Certainly some has, particularly overseas, everyone's worrying about that, and there's a lot of positioning to try to get into domestically oriented companies that don't have exports, say from Europe or China to the US. So there's certainly some there, but my feeling is that in the US, the consensus is that it's more bark than bite, and the market is priced for a very placid type of economic outlook, and I think tariffs could throw a wrench in that.
And so with tariffs throwing a wrench in that, then would there be dip buying opportunities that could appear that seem appetizing?
Well, yes, certainly. I think it's going to be a very volatile situation. I mean, we just saw that in the past 24 hours that markets reversed significantly, not only equity markets, but currency markets. So there's going to be a lot of opportunities for investors who have strong opinions as to what companies will gain market share over time, grow their earnings, throughout this, and who's on the right side of this tariff war.
How much does the stronger dollar complicate that picture, the investment picture right now?
I think the stronger dollar's a headwind for multinationals, and I think it's one of the reasons why mid caps may be a better idea than large caps. To the extent that the tariff war escalates, you're going to see kind of a race to depreciation. You're going to see central banks in other countries look to offset some of the headwinds from tariffs by reducing interest rates that will cause their currencies to decline, and that will take some of the brunt off of the tariffs. And so the U.S. will be left with a stronger dollar, and that'll negatively impact the ability to sell overseas, or the translation from profits overseas back into U.S. dollars.
FactSet was looking for the S&P 500s to see calendar year growth in earnings of about 15%. It seemed like that was largely the consensus. Do you think that tariffs kind of throw a wrench in that as well, in that projection, and are we due for some recalibration?
Well, the tariffs that just went into effect probably don't throw a big wrench in it. It's probably on the order of just a percent or two, maybe headwind. But if it escalates, I think it does throw a wrench in that. First of all, the strong dollar is one of the best correlations to earnings surprises, and a negative correlation. So stronger dollar means weaker earnings surprises. And I think it puts at risk that double-digit earnings growth rate.
Brad Neuman, thanks so much for taking the time to join us. Appreciate it.
Thank you.